Hi, I'm Dinar Turaskar, and I'm going to talk about value at risk aggregation and reporting using Hadoop and Spark SQL. Uh, in this talk, I'm going to cover, what is value at risk, where is it used, and why is it important. And I'm also going to briefly cover how do you calculate value at risk, and the challenges of value at risk aggregation using traditional databases, and why does Hadoop make a difference. Um, After that, I'm going to show you how Spark and Hadoop and Hive sort of transform value at risk reporting and aggregation and allow users to get deep insight on demand. And finally, I'm going to sort of extend, I'm going to cover how you can extend the same principles to other domains and build a high definition warehouse using the Hadoop and Hive stack and empower your users. So to start off with, I'm going to briefly cover what's value at risk and why is it important. So value at risk is the predicted maximum loss or the worst loss over a target investment horizon given a confidence level. And how do you calculate value at risk? So basically for the stocks you have, you get its price history going back in time. Here I'm taking Google, and this is the price history of Google going back a year. Once you get the price history, then you need to find the returns, and returns are nothing but the amount of money you lose or gain every day. Once you get the returns, you need to sort the returns and find the worst returns, and the 95 the worst returns for the given confidence level give you VAR. So in this case, the worst 99 percentile return is your value at risk, and that's how you calculate value at risk. So there's a few properties of value at risk. So the larger the investment horizon, the higher the value at risk. So in this case, if you have 1 day, so this is Google's 1 day value at risk, which is $14. So if you held $1,000 in Google shares, you would lose, with a 95% confidence level, you would lose not more than $14. That's another way of saying that 95 days out of 100 you lose less than $14 in 1 day if you held $1,000 in Google shares. Similarly, if you increase a confidence level to 99%, then your value at risk increases. So if you wanted how much you would lose at the most 99 days out of 100, then it's $78. So your 99 percentile VAR is $78. Similarly, as you're trading, as your investment horizon increases, your VAR increases too. So a 10-day 95% VAR is $111. Similarly, a 10-day 99 percentile VAR is $275. So value at risk is one of the most important trade measures, risk measures, because it's it takes into account the correlations between your assets, and it's used widely in risk management, margin calculations, regulatory reporting, capital charges, and pre-trade decision making. So value at risk sort of makes sure that more volatile assets have higher risk, and it takes into account correlations between your portfolios. So brokers have a much better view of how risky your portfolio is and can make more accurate margin calls. Similarly, you should look at your value at risk in your investment portfolio, and you can have a better diversified portfolio, giving the same returns with lower risk if you try looking at VAR. So value at risk is challenging with traditional databases because it's not additive. So if you have two assets in your portfolio, the value of risk of your portfolio does not equal the value at risk of asset A and value at risk of asset B, which means that if you want to calculate value at risk, you have to recalculate the measure for each and every point that you report. So this makes it impossible to do in a database, and typically every time you want to calculate value at risk, you have to run it through analytical engine. But Spark SQL and Hive kind of support complex data types and user-defined functions, and these allow them to run complex analytics on each and every position and each and every aggregate. So Spark SQL and using Spark SQL and Hive, you can store all the returns using the complex types supported by Hive and Spark, and you can use user-defined functions to do the calculations I mentioned earlier. And this means the users can get value at risk as any other standard query. And that's a big game changer. So if you had Spark or Hive, you could get recalculate value at risk within minutes rather than hours that traditionally would take, if you had to calculate value at risk, recalculate value at risk on a bank's portfolio. And the same concepts kind of apply, using Hive and Spark SQL. You can build a high definition warehouse. Your warehouse does not need to be anemic like traditional warehouses, and you can sort of add complex logic in user defined functions, which can run on Spark or on Hive, which makes a big data or fast data warehouse much more powerful than traditional warehouses. So I'm going to sort of cover this in more detail, and if my talk's selected, then hope to see you at Strata London. This one more thing that I didn't cover, which is what this also enables is, what a high definition warehouse enables is running scenarios where if you wanted to do what if analysis for different scenarios, then using the power of SQL you can define the scenario. In this case, I'm showing what's the value at risk if some business was exited, or if a bank is planning to exit some business, or what is the value at risk if if the customer is planning to do a new trade, and on this basis you can do a margin call. So thanks again, and hope to see you at Strata.